We're looking at the Caixin data that we got today, services data out of China, a big beat in terms of that data set. Are we starting to look again at the possibility of a V-shaped economic recovery?
Thanks for having me. So we are seeing some recovery movements, some flow coming back into the markets and leading to a bullish tone. I would still be cautious. I think the guiding principle that we are looking at and questioning is, do our portfolios look the same as they did before the COVID-19? If the answer is yes, then the next question is why, right? So this COVID-19 crisis and really kind of the end of 2019 changed the volatility spectrum of all asset classes. It changed their idiosyncratic nature, but it also changed their relationship with one another. So we're looking at building portfolios that are robust and effective for the next 10 years, and that's going to require some reassessment. For example, investors should be cautious about moving back into broad market indices, ETFs, and such like that, and asset classes like that. This volatility is going to allow for an opportunity to generate alpha, and that's where investors should be looking.
And Paul, we've talked about the disconnect. It's being talked about widely, of course, between the market action and what's happening on the ground, whether it's the protests in the United States or the tensions between Beijing and Washington. How do you hedge as you start to reallocate and reshape your portfolio?
So it's an interesting dislocation, right? So if you look at the VIX topped out at about 75 a few months ago at the peak of the COVID-19 event, and it's back down to the 20 level. Before COVID, it was into the 14. So there has been a change in the fear in the market, seemingly. So if we look at the VIX, it does look like there's less fear in the market. However, if you look at where the protection is being bought, if you look 15% down from the S&P 500 where puts are being placed, they are still being bought at the volume and even a higher price than they were at the beginning of the virus, meaning that fear of a drawdown is still in there. So the idea is to be looking for opportunities in the middle scenario range, but covering the downside, spending a little bit of that return covering the downside, and that's really the portfolios that we're putting together, is portfolios that are robust, efficient in diversification across different markets, across different asset classes to achieve those returns, but really spending a little bit of money to cover our downside using put protection and other manner of protection.
And Paul, I mean, it's hard to play by the traditional playbook these days, right? I take a look at this explosive recovery in U.S. stocks, and then alongside it, you see a pretty decent rally in gold. You see Euro stocks have also recovered, and German yields go further negative. How difficult is it to actually price in risk at the moment, and when everything seems to be going up?
It's a different spectrum, right? So if you look at risk, you have the certain risk, or the kind of the expected risk, I would say. And then you have the uncertain risk. Right now, we're at a point where the uncertain risk is very wide, right? We have the numbers are still coming into the market. The actual impact of the COVID-19 still coming back into the market, and that's why we have seen a little bit of weakness in the emerging markets, right? It's almost a litmus test of recovery. Because investors are sticking to the safe havens. When we start seeing a little bit more recovery in the emerging markets, which we have seen over the last week or so, that is a positive sign. But there's still a lot of uncertainty on actual impact of COVID-19 in the market. And in order to overcome that uncertainty, we really need to invoke direct and hard protection. So it's not about looking at signals. It's not about looking at the VIX level. We really need to put a floor on our portfolio so we don't get that massive drawdown that we've seen in the last couple of months.
So in terms of the market risk, though, I mean, it seems like there's nothing that can really bring these markets down, whether it's geopolitical tensions, a deep recession, unemployment, U.S. protests. I mean, what do you think is the biggest market risk that investors are seemingly overlooking right now?
Well, I think that what we're seeing right now is kind of a return to positivity and a hope for bullishness. But it's really about as we move into the kind of the summer months and through into the end of the year, we're really going to see the impact of this virus. So it really depends on whether you're looking short term or you're long term. Short term, I think that we're going to see some bullish moves, and those bullish moves are going to be tied to sentiment and positivity on how governments are acting on this virus. So, for example, stimulus packages are definitely going to see positive moves on the back of that. Governments reopening, that's going to be quite bullish. But at some point, we're going to switch to kind of a longer-term perspective, and that's going to be more focused on the numbers. And that's where we're going to see not necessarily a second correction, but a volatility returning to the market. And that's really when investors need to set up their portfolios right before we get to that point.
Paul, we've seen dollar weakness, of course, play out quite strongly this week. Dollar weakness playing out quite strongly. You and I know what I mean. The dollar is weak. That's positive, of course, for EM. We're seeing that play through to assets in this part of the world. What do you like in the FX space?
So dollar weakness is an actual opportunity. We see volatility in all FX markets, but again, that's going to be a quite opportunity because the dollar strength has essentially taken out a lot of the volatility. And as a portfolio manager that looks at volatility to generate alpha, it's hard to do that when there is no volatility, right? So we're going from very concentrated markets. The best trade in the last 10 years was the U.S. market, and it created a lot of strength in the U.S. dollar. Now, you asked me where are we focused? We're actually focused everywhere. We're looking for opportunities in many, many different markets because we see a lot more volatility there and therefore a lot more potential alpha. What's helping this is that the hedging costs are actually quite low right now as well because as the interest rates decline and become a little bit more relatively the same, the hedging costs go down as well. So right now, I think that the FX market can be a very good exposure to have in portfolios to generate that alpha.